All right, ladies and gents, let's get started. We'll get started in a few minutes. Get yourself settled in. We'll get ready to roll. Always seem to have some action, some market spice on Tuesday, and today is no different. It's almost like Tuesdays, they know the market is going to do something interesting because we've got the webinar. Yeah, we've got a lot of, obviously, stuff coming out of the Middle East, which is causing an oil bid. You know, oil's up almost 5% on the day. It's sitting at high 71.50 on the spot. It's rolled up from got to $67. We've got Nasdaq's been smashed. Well, I say it's been smashed. It's not actually too bad, right? Dow's only down 170 odd points. SPOO down 32 handles. It's not too bad. Obviously, oil's the biggest one that's moved, or the biggest mover out of the bunch, as you would expect. Geopolitical tensions in the Middle East, oil supplies, people concerned about that, people buying oil, people who consume oil or need oil to run their business will be thinking, let's hedge some, let's buy some. So that's why we're getting, obviously, the price rise and concerned of supply restrictions. What else got across the board? Look at my other screen here. Crypto down a bit, gold up as, yeah, probably what you'd expect, only up 1% or so though. Yeah, bit of a mixed bag, but oil seems to be the one that's in play as you might anticipate. So I had a look on the FT. It looks like Iran have launched a missile attack. There was rumors before. I didn't see a massive oil spike after that news came in. FT is normally pretty reliable, right? I'm just looking at my phone here, by the way. So let me just double check that's the right everything in there. Yeah, 11 minutes ago. So let's see how it unfolds. As traders, we kind of can't really predict. All we've got to do is understand what's influencing the price and look at price actions in response to that, or prices response to that. So obviously, stuff going on in the Middle East, there's concern of a wider war. Whatever we think about that, whatever our viewpoint on anything is, or our opinion, it doesn't matter. It's like that's affecting price. How has price responded? Well, that's how price responded. Not gone crazy on crude, but there's a bid coming in there, a little bit of a soft bid. So will that die off over time as the tensions die down a bit, or if the tensions increase, will crude then just kind of accept that? Who knows, right? Who knows? Equities, for trading equities, for trading currency pairs, it just pays to know what's the market driver, right? We've kind of shifted. We haven't really shifted, but inflation, election will come into play soon. Now we've got this potential, real tinderbox going on in the Middle East that's kind of taken a new level, a bit of a turn for the worst. So there's plenty of things that are going to influence price, and I think just being aware of the headline risk when you're trading these type of things. Okay, ladies and gents, let's get started with tactical trade timing techniques. Before we do, I want to read to you a slight excerpt from this book, which is A Psychology of Trading. Can you see that one? Yeah, you can. Psychology of Trading. This is Brett Steenbarger's Barges. Yeah, I've known him for many, many years. I haven't known him, but I've known of him for many, many years. So I started trading, and I don't know Barger or Barger. Anyway, whatever you want to, however you want to pronounce his name, I'm sure maybe one day I'll have him on my podcast and he can correct me. Okay, so this is a really interesting piece. Attend to yourself before attending to the markets. If you are not in your trading zone, you don't want to be putting your hard-earned capital at risk. Frustration after one or more losses or missed opportunities, eagerness after scoring a win, boredom and a desire for excitement, fear and procrastination at times of opportunity. These are some of the most common ways in which emotional shifts alter your perception and response to events and color your trading. Then it goes on to say, once you've taken your emotional thermometer, or my emotional temperature, should I say, you then work out if I'm running too hot, too cold, and have techniques to kind of get yourself down back into kind of in the zone. If you go to another trading book, Trading the Zone, back into that point where you're not so relaxed that you don't care, you're not so stressed that you're kind of making emotional decisions. And so that's a really good piece. Attending to yourself before attending to the market. I think many traders could do well with that. And that's from this book here. Okay, so my well-thumbed copy with various little bits bookmarked in. Okay, so let's get started, ladies and gents. We are going to talk about trading, tactical trade timing techniques. Welcome to the webinar. We will run for around 45 minutes, and then I'll have some time for Q&A. Although I have got a lot of slides today, I want to really jam-pack a lot of tactical, useful information for you. The idea being that you can take away the bits that resonate with you. That's always how I've consumed webinars over the period of time. I've always kind of grabbed little bits that I like and discarded stuff that I didn't, and kind of made that into my own. So that's my objective for you today. I'll introduce myself in a moment, but first of all, before we move on, we have the obligatory disclaimer. Hopefully, you're all aware of the risks involved when trading leveraged instruments like a CFD or a spread bet. Double-edged sword, right? You can make money really, really quickly, but you can also lose it really, really quickly. So just be aware of the instrument you're trading. If you're a brand new trader, make sure you do all the due diligence, make sure it's right for you, make sure you understand the product, make sure you know how to manage the risk. And then when you're ready to go, personal responsibility, right? Make your own decisions, start small, all this type of stuff. But please just understand that, this is a risky business. And, when you're trading on margin, especially, it can get nasty very, very quickly, but that's the trade-off we take, right? So that we kind of, with one hand, it's kind of that scale, right? We want to say, okay, I'm prepared for that risk because I want to really maximize my reward, and so we take that and understand the consequences of that deal. So we're going to talk a little bit about risk. We're going to talk about kind of reward and trying to get better at our trade timing. First of all, great quote here from Michael Marcus. In order of importance to me are the long-term trend, the current chart pattern, and 3, picking a good spot to buy or sell. And that's what we're going to focus on today. How to get better at really timing the trade. And like I say, there's a lot of stuff to cover because I hate really going into something without adding context, because trading is all about context, and there's other things that play such a big part in the decision we make, especially intraday or whatever time frame we're trading in the heat of the moment, that sometimes I think it doesn't do us justice to focus so on the micro without going back and looking at a 36,000 foot view and saying, well, that's important. And these are the techniques, if you like, or tactics to use to incorporate everything. So let's get rolling. First of all, I want to remind you guys that I've got a couple of decades of trading experience, starting in 2001. But unlike a lot of people out there who claim to know everything, I don't claim to have all the answers, right? I've been trading for a long period of time, and I've also seen many other traders over the years working in Traders Mastermind. I've seen them come up, I've seen mistakes they've made. And so really my objective is to share experience that I've got as a trader for those many years, and also to share some of the things that I see others doing, the good and the bad guys who have kind of made it through the mud and sort of waded through and got out the other side and doing very, very well, guys who are still struggling. So I think I'm in a kind of unique perspective, or a unique position, should I say, to kind of assist you and put hopefully some reasonable knowledge in front of you. But always do your own analysis, your own research, do your own homework, whether it's me, whether it's someone else suggesting something, sharing some idea with you. The best way, I think, to progress is to go, that's interesting. Let me now dig down that rabbit hole a little bit more and mold it into the type of thing that works for you. Because we're all individual, right? Remember when I was learning to trade back in 2001, 2, 3, that sort of period of time, I went to a seminar in London. Internet it was around. I'm not that long ago. It was around, but we didn't have kind of the sort of content and resources you got now. I went to a seminar in London. I remember kind of watching this guy talk and showing indicators and stuff. And I remember going back and digging in this rabbit hole. And really, it didn't take me long to realize I didn't really want to trade like that. I wanted to trade with price action. And so I went off and kind of just watched price. I learned with that objective in mind. So things take time. Implement a change, stick to it, observe the results, and make some course corrections. I think a good way to proceed in trading, rather than making adjustments all the time and you kind of go around in a big circle. Is to make a little adjustment, run with it for a while, and then audit the performance. So in the context of this webinar, if we're talking about adjusting your trade timing or tweaking, making some little tweaks here and there, which we'll go through, of course, in a moment, plenty of chart examples, plenty of stuff to run through. If you do decide to make some adjustments, and it's your personal decision to do that, I think make it and then run with it for a while before you audit what's gone on. Say, I've adjusted the way that I enter the trade. I've adjusted the way that I do this. Let me see how I get on over a decent sample size. Because what most traders do, and listen, any mistake that traders make, if you've made, I've made it. We've all done it, right? If you've got enough experience in the markets, you will have made all those mistakes, and hopefully they are far, far behind you. But one of the mistakes traders make is they make a change, they make a trade, they go, trade's not working, I'm going to ditch that. and really you need to get a good sample size under your belt. Okay, so whilst oil is rallying on my screen, I should probably minimize that, even though so it doesn't distract me. But why timing matters. So if you take you, we know this, but I just want to kind of just show it to you in black and white, if you like. We've all been on the wrong end of this or the right end of this. A few ticks can change a trade's outcome completely. You can be right and you can just get it wrong just slightly because the timing was off. You're a little bit early to the deal, comes back, stops you out, then goes in your favor. A little bit late, and then your stop's got to be too wide. The risk reward ratio structure gets ruined. So we're going to look at that in some detail today, and it applies to both entries and exits. I know we've talked about this is going to be talking about trade timing, but as I was going through and making these slides and thinking through, what the outcome is I'm trying to deliver to you. That's always kind of my North Star. Okay, what I want you to take from this, and then working back. So what needs to be included for you to get to that goal at the end of the 45 minutes? That's how I operate. But very often I go, oh, I should really include that. I should really include that. So I've included, we're talking about entries, fine-tuning entries, but also exits as well. And you'll see why it's important in a moment. And we all know this, guys, especially in trading, the difference between winning and losing can be so small. You've probably had a situation where one trade has just pinged you out to the tick and it's gone on and done a massive run. And that was the trade that would have made you green on the week. And so that one or two ticks movement, that points movement is just the difference. Now, am I here to say that you're going to have perfect timing? That's never going to happen again? No, absolutely not. I mean, that will be fantastic, right? But that's not the case. I'm not here to pretend that. And obviously, anyone says that, it's untrue. But I think we can look at our trade timing, and if we can improve our trade timing just a little bit, it can have a much bigger outcome. And you adjust something about adjusting a few degrees, heading on a ship after a certain period of time, the distance between where you were and where you are would be massive because of that small adjustment. That's the same with trading. Okay, so a few examples for you. Just why did I don't know, I need to include this. We know what happens here when you get trade timing off. 1 minute shot here of USD JPY, dollar yen, I think it was today. Imagine if your trade timing was a little bit off here and you got pinged, you would have missed out on a big move. Even when you're pulling your stop up, let's imagine you came down to the lows, it started to retrace, and you pulled your stop up to 50% of the move, which wouldn't be unreasonable, right? You're getting just pinged out before it's carrying on and rotating lower and giving another 50, 60 pips. So we know this can happen. And so we're trying to avoid this as much as possible. And I say we're never going to get perfect, but there are ways that we can really mitigate and filter out ways to get involved in trades so that we aren't getting caught out as often, because it doesn't need that much difference, right? You need to make a small adjustment, improve your trade timing a little bit. If that has an impact on a handful of trades over the week or over the month, those might be the trades that are difference between getting pinged out on a little wick or getting pinged out because you're a little bit early, a little bit late, and getting a 5-hour winner. And that's a massive difference over time. So I think it's an important skill set to develop and an important aspect of your trading to really focus on. Okay, so moving on to a quote that stuck with me. Now, when I kind of was brainstorming some of the things to cover here, and I've really started listening to this hedge fund market wizards book again. I think it first came out in I want to say 16, is it 19? Maybe 19. I'm not sure. Anyway, it's one of the Jack Wager. He's not going to like me for that, is he? Jack Schwager series, the Market Wizards series. Definitely recommend these series. This is the latest one. I think was Unknown Market Wizards. This is the one before that. And okay, you might be like, well, I'm not a hedge fund, Mark. I'm not interested. Blah blah blah. It's interesting because even though you're not a hedge fund, you then can see how big money makes their decisions and how people, it's a person at the end of the day who's making the decision whether they're trading, a short-term basis, whether they're trading a long-term basis, whether they're trading global macro, whether they're trading, whatever they're trading, right? It's a person making that decision. And actually, if you go, just a side note, if you go and watch a YouTube video recently, David Tepper talking about the Chinese stimulus, okay, and really listen to what he's saying with that. And he talks through about how he went above his risk limit when he saw the Fed come out, how he was peeling stuff off, how he was coming back on. So this is what moves markets, right? Big players moving markets, and that is opportunity for us. So going back to this point here in Hedge Fund Market Wizards, there was a quote that stuck with me, and it's just stuck with me for so long, and I don't know why it resonated so much. Maybe you can understand in a moment. Michael Platt from Blue Crest Capital said this, and he was talking about, I'm sure he was talking about an actual trade idea that he couldn't express, but it's basically this. There are times when you can see a market situation developing, but can't find a low risk way to express the idea. And I thought, that is so interesting because as an active trader, if you're a day trader, swing trader, whatever time frame you're trading on, how often do you have a good hunch and a good idea where the market's going? You're like, I can see that unfolding. That's going to rip to highs. We're going to pop through here, or that bid's going to start lifting off there. That's an exhaust. You see it. It just happens when you start to get a more experience under your belt. You just start to see this. But expressing that in a low risk way isn't always easy. And that I think is where many traders stumble. They go, okay, I've got the idea. We're going to go to highs. We're going to push. We're going to break through the highs, and they just buy. And they go, oh, the stop should be here. And it just ruins the structure of the trade, especially when we're trading with leverage and we're saying, okay, I want to margin up. I want to, our goal as traders, right, is to make as much money as we possibly can with the least amount of risk possible. That's the goal for every trader. We're trying to use leverage to our advantage. We're trying to fine tune entries as much as we possibly can so that we can ramp the size up a bit. Okay, I know that there's a incremental risk with that, but that's what we're trying to do. We're ultimately trying to find a place where we can do that. If the stop's too wide, and the target's not that great, then it's never going to work out. So we're trying to juggle these little different dials, aren't we, and adjust them. And so, sometimes we can see something unfolding and the trader in you sees that developing, but there's one more piece of the puzzle, which is, well, where can I take this trade to express the idea? I've got the hypothesis, I've got the thesis, but now I need to find a place where I can express that trade. And that was why that was interesting to me, is that even this guy who was trading very, very limited leverage, if any at all. Even he was saying, I've had this idea, and it would have been a broad idea over that was going to play out over, I guess, years or months or years, right? Even they sometimes go, hey, I like that. I can see it unfolding, but how do I express it? I couldn't find a currency for it. He couldn't find an option contract. Appreciate that I was here trading maybe a limited number of markets, you're trading the indices, you're trading some of the FX pairs, some commodities, etc. I get that. So it's not quite the same, but it still is from a technical perspective. You think that's going to happen, but how can I then express that? So that's what we're going to kind of focus on a little bit today. So small changes in entry can have a big impact on exit. And that might seem obvious. You might be like, yeah, well, all right, Mark. Well, you're a genius, pal. Well done. But just think for a moment what that means. And I'll show you some examples. And sometimes this goes without us realizing it, or this happens without us realizing it. So we start to see, we're hopefully you're journaling your trades, you're going through, you're looking and marking up your charts, see this, that, the other, and you kind of go, oh, stop was there, I got pinged out on this, and my pin on the day was this. But actually, when you really look at your entry, and you can see how important it is to be as precise as you can with it and almost have unrealistic expectations. That sounds stupid. You're like, what are you talking about? Unrealistic expectations. I think we can all go in as traders each day. You've got your setups, you've got your strategies, you've hopefully got your plan, you've got your risk parameters, all the stuff there. But then actually saying, I am going to fight for the best possible entry I can on each trade. I'm going to talk about what that means, but just having that in your mind and your thinking helps with performance, because rather than just going, well, I think the market's going to go here, it's like, okay, that's the first piece of the puzzle. The next is now to find the very, very best entry I can, the very best. And that's missing from so many traders' playbook that I think that actually it ruins quite a lot of traders who have got a sound strategy. Great strategy, great approach. It's probably pretty good on paper, but just a little bit slack with the entry and exit. So some visual examples in a moment for you, but if you've got a fixed RVR, and RVR by RVR, I mean risk versus reward. So if you've got a fixed kind of reward, so you say, right, I'm always going to risk one to make two, maybe that's the way you approach things. If you're assuming your stop has to be in a structured place, has to be quite wide, that makes the target unreasonable. Again, an example in a moment to clear this up. And if you've got a fixed target strategy, like I think it's going to hit the prior high, your stop is going to be in the sensible level. It ruins the whole risk order ratio of the trade. So as an example, right? And let me slow things down and kind of hopefully this makes sense. I'm pretty sure it will. So imagine you are I'm sitting using the yen example again from today. So let's say you're watching the price up here, okay? And your thesis is, I think we're going to mean revert back to yesterday's high, which is that red line there, running around 143.95 ish, give or take. Okay. So that's your thesis. That's your trade idea. That's the one you want to express. And the market's sitting here and it's up at highs, and you think, okay, that's I've gone one too many slides here. Well, that's that's a trade idea. I think there's a good 40 pips in that, 40, 50 pips in that trade, depending on where I take it. And so you start from that North Star. Okay, now you would reasonably say, okay, and most of us would do this, and I think this is a very sensible thing to do. If we have one push through the high that fails, that's not going to be a bad place for a stop, right? If you were trading this short, and imagine you were looking at around here, around 7:30 UK time, and you saw a little pop up, and you were thinking of getting short, and your thesis was, I think we're going to come back and tag the prior day's high, you would reasonably put a stop above there. And this is the thing I want to kind of reiterate is that the stop is still going to go in a sensible position, right? That's our anchor. We've always got that there. We can fall into the trap of wanting to make it really, really tight, or maybe widening off. But let's imagine you've got the stop in the same place regardless of your entry. Okay, so if wherever you entered on here, your stop's going above there, your target's there. So how would that look? Wrong way. You'd have your stop here, and imagine now, okay, a few different scenarios, which are all reasonable. They're all fine, but I just want to highlight the significance of entry on a very bread and butter strategy. Maybe one of you traded this today, but this is a very, very simple, obvious play. There's nothing obvious about it, but it's a very simple play that you may well have spotted. You may well trade happens. They happen multiple times a day across different markets. A mean reversion play back to what you consider a mean, prior day's high, spring stretch, looking for that contraction, or I sometimes call it an outside in type trade as opposed to an inside out. So pretty simple stuff. Not looking at the strategy per se here, but looking about the effectiveness of the entry and then how we can improve that over time. So imagine a reasonable entry would be, okay, I've seen ignition bar with a big, decent range on the bar. It's already wicked above the high. You've got that little wick above the high, one little flurry, and now we've got an outside bar with ignition. Okay, shorting it on the close of that wide range bear bar, pretty good. Right? I think that's a pretty good way of getting it. And you may agree, right? If you're that type of trader, you'd be like, yeah, you know what, it's sat there, it's had one more little flush up. Some people call it a liquidity grab, fake out, whatever you want to call it. It's not done a breakout, it's not carried on, and it's rolled over. The chance now is that game on, my hypothesis of it coming back to the prior high or the yesterday's high is strong. I want to take it. And so let's say you took it there, and your stop very, very reasonably would be a few ticks above that high, because you don't want it to come back above the high, right? This is not a webinar on stops, but this is pretty much fundamental stops 101. You're going to put stops in a place where the hypothesis is negated and the trade thesis is no longer valid, right? And if the price goes back above that high, I think we're all in agreement then the thesis is probably no longer valid. Okay, now and then you might get a double kiss and roll over, but generally speaking, okay, so how does that structure the trade? Well, if your target is fixed and your stop is fixed because your hypothesis is here, your stop is here, and your entry is very reasonable on that close of that bar, you get a 2-to-1 risk reward ratio. I think that's not too bad. That's probably a trade that everyone would take. Like 2-to-1, reasonable probability of success, decent place enough for a stop. Okay, fine. You can work with that. Okay, so now imagine if we rather than took a short on the close of that bear bar there, ignition bar, the momentum ignition to the downside. You said, you know what? I'm going to wait for a break of that low. So if we go back this low here, I think you can see my mouse. This low here, I'm going to wait for a break, which some people do. They want to wait. They want to see. They want to wait for the confirmation. Oh, I just wait a little bit. Imagine now your stop is still the same. For the trade to be invalidated, it has to be above the high, and your target is still the same because that's your hypothesis, right? We're going to come back to the prior day's high. Now look how your risk reward ratio, by waiting for that extra, in this case it's 5 minutes, for the confirmation that everyone says to wait for, you have well and truly screwed up that trade. The risk reward ratio on that trade is now 0.721, which is to say you have to have a pretty decent hit rate to make this work over time. And in fact, I'd argue that this is not even worth taking, because when you're trading something like a currency pair that's so efficient, you need to have both on your side. You need to have a risk reward ratio high. You need to have a decent win rate. You can't be scratching around looking for scraps. I don't think. Now, some people disagree, and that's fine. There's plenty of ways to trade. But I just want the point of this is to show you how much of an impact the changing of your entry is. I'm going to look at tactics to kind of improve that in a moment, but this is really to illustrate everything. Okay, now imagine if you were watching price very, very closely and you saw it rally up and then you saw it immediately lose that bid. Immediately lose that bid, and you were on it, you were aggressive, you're ready, and you shorted it as it came back through that high. Now, 5 minute chart, I appreciate you're asking a lot from a trade in this point, in this perspective, but it could be a 15 minute, it could be a daily. And actually, dailies are that's a very common pattern. We break through the prior day's low, we pop back up. So imagine if you're there watching that tape move and you hit that bid as we're rolling back through here. So you started to short it through that high. Your stop was in the same place, your target was in the same place. Look at the risk order ratio. You've now gone from 2 to 1, zero point 0.7 to 8 to 1 just by making a little adjustment. The trade is exactly the same. The thesis is the same. The thesis of, I think we're going to push back to price, but the timing is very different in those three different scenarios. And it has had a huge, huge impact on the trade. And this is why I want to reiterate this, because it's so, so critical. If we're just a little bit sloppy with our entry, a little bit late, or a little bit early in some cases, give some examples in a moment, it changes the structure of the trade massively. Not only the structure of the trade, the structure of your strategy, the efficacy of your strategy, the expected outcome of the strategy, the equity code. It just completely changes it massively. Trade one here, examples 2 to 1. And let's imagine hypothetically you were risking £100, right? £100 on a trade, 2 to 1, you're going to make £200 profit on that first trade. And that was on the ignition bar. You did the ignition bar, you hit it straight away, bang, your £200 profit. If you waited for a break of, what do they call it now, structure or the support, whatever you want to call it, not the fancy terms are these days, but a sensible level below a key support area, the last swing low, whatever you want to use, that was 0.7 to 1, right? £70 profit. And then trade 3, which was, okay, appreciate super aggressive. You had to be on point. You had to be prepared for it. Was £800 profit. It's 11 times the profit of the zero point 0.7. That's huge. Same trade, same idea, everything identical apart from that entry within that small window of time. Using the same stop, of course, because that was a thesis, same target. And the key here is not, I'm not going to say to you, oh, you're going to get all these trades immediately as they turn. And no. I'm not here to be unrealistic. I'm just saying that look at that would be perfect. Absolutely perfect. If we caught all that, beautiful 8 to 1, thank you very much. Take those all day, every day. No, I mean, really, in real terms, we're not going to catch it. But the point is this: if you can improve that entry just a bit, it has a huge, huge impact on the bottom line, a potential impact on the bottom line. And that's what we're trying to do, right? We're trying to make these little changes, little adjustments that are going to have a significant impact on our trading. So, just one final thing here, because I did mention this initially. If you said, so imagine we went back to this slide, right? We've got 8 to 1 trading that very aggressively on the fake out. As it came back through, you were hitting that, bang, stop above there. I mean, I appreciate it's a very, very intense example, 8 to 1. But if you try to do that 8 to 1 on a kind of break on the ignition bar, which is reasonable, you're now looking for a massive unrealistic target. So when I talked about, okay, some people like to use a target first approach, which is what we were doing the example. The target was the prior day's high. That was the thesis. But if you're a trader who likes to use a fixed RVR, look how bad and unlikely that target is going to be hit intraday, at least, if you're forcing an 8 to 1 risk order ratio trade. So however way you wrap it, the entry is very, very important, especially for us. By all intents and purposes, we're aggressive, right? We're trading with leverage. We're trading on a short time frame. That's considered aggressive in the trading world, right? So from an aggressive perspective, it matters so much, so much. Okay, so now I hopefully we're all in agreement that it's very, very important to really get the timing right. And we're also in agreement there's no magic pill. There's no silver bullet I can say, hey, do this and you're going to suddenly make 8 to 1 trades. We live in the real world, guys. We're on the front line. We're trading. We know how the real world works. Okay, so here are some ideas. So how can we improve our trade entry? Number one, I want you to rethink the whole confirmation thing. I just don't like. Okay, this is personal. You trade as you like. There are other traders who absolutely do very, very well, waiting for confirmation. But I just urge you to rethink it. Do you need to have confirmation. And what are you actually getting from that? Is that just soothing that inner voice that says, oh, the trade might not work? Or do you really need it as part of the structure? Now, okay, I understand some trades do need an extra layer of confirmation. I can't think of many, but some strategies might do. And that's fine. If it's part of the strategy, that's fine. But to add it into every single trade, oh, I'm just going to wait for confirmation. I'm just going to wait for this. You can see how you can ruin what's a perfectly good trade. Because if you take 100 of those trades, right, let's say you got a 50% success rate, all of a sudden, if you're waiting for confirmation of the break, that's not a profitable strategy because the zero point 0.7 to 1, a 50% hit rate does not make you money. You lose money. But if you then instead went to 8 to 1 or even 2 to 1, between 2 and 8 to 1, all of a sudden that becomes a profitable strategy. So waiting for confirmation ruins the edge of your setup in that example. Not all the time. And then we have to speak in generalizations with trading. We can't, there's always these specific outliers and kind of edge cases, of course. So you really need to wait. Can you get the same signal earlier? That's the bit I probably should have highlighted because that's something that I'm often thinking. I'd like you to think the same. Can you get on that trade earlier? Can you be smarter about where you're entering the trade so that you can increase the risk reward ratio of the trade, so you can improve things by just being a little bit more aggressive? It doesn't always play out, and I've got to be careful here because I don't want people to go out and go, oh, I'm going to be super aggressive and punt away and everything. That's not what I'm saying. I'm just saying, can you be smart about preempting some of the moves and some of the setups and strategies that you deploy? And one thing to consider is that the signal does not always equal the trigger. Where was it who said this? This is something someone said far more eloquently than me. And it's like in all trading, you look at some of the great traders, they've learned from some of the great traders who are around in the kind of early 1900s. They've learned from traders beyond. So it's passing down the generations, if you like, and just being changed very slightly. But one thing to way to think about trades to help you is to say, well, actually, there's two ways of looking at it. I know I've discussed this before, and I think the best things actually are repeated multiple times from different angles, but a signal versus trigger. So a signal to me is like, okay, I'm taking off the safety, right? The safety catch has come off. I'm not pulled the trigger yet, but I'm ready to go. Right? I've got my target in sight, my filter, I'm ready. There's my trade. I'm taking the safety off, but I'm not actually pulling the trigger. I need to see something else, not confirmation, but there's one more layer of something. That doesn't necessarily mean confirmation. It can mean something very different. Look at the moment, but it's the context of the trade, the hypothesis, the thesis, the signal of the trade, and then the trigger. Because often the signal bar gives you a trigger too late. Like if you sometimes wait, oh, I'm going to wait for an ignition bar, and you're then a 15-minute, the damn thing closes up here. It's halfway to your target, screwed up the whole risk reward ratio. If you're going in then, you ruin the trade, just like we saw in that example. You ruin the whole trade and all the hard work, and you're chasing the damn thing. The stop's got to be too wide. The risk reward ratio structure is completely messed up. It doesn't work. Whereas that could be a signal. We'll look at examples in a moment. That could be a signal, and you go, right, I need to see this for a trigger. And that might be a pullback. It might be a little retracement. It might be one more dip. There's one more thing you need to see, and that's fine-tuning the entry. Okay, so let's have an example. Yesterday, I think this was example from DAX, right? DAX, let's imagine this is, again, hypothetical. I'm just picking stuff out and showing you it visually so we can kind of appreciate what we're talking about here. Downtrend, you want to be short. You're a good trader and you want to wait for a pullback, right? You say, okay, I'm going to wait for the opening bell. There's a downtrend here. I want to get short, but I want to wait for a pullback. It's not the cleanest chart, but I'm not going to go back 50 years and cherry pick the most perfect example. I want to use something recent, right? I want to use the recent chart and say, hey, real world things aren't as clean and crisp as you'd like all the time, but it's up to you to decide where to take it. Okay, so you wait for a pullback. You see the ignition bear bar. Right. So now you might want to get short. It's a decent range. Okay, what do you do? So if you shorted on the bar close, fine, and you use a structured 2-to-1 risk reward ratio trade, let's all agree that the stop would probably be above that ignition bar. Momentum ignition comes in, you've got a downtrend, you want to get short, you see this kind of pennant type trade, a little pullback, you see the ignition bar to the downside, you're like, right, we're game on. This is the biggest wide range bar we've had over this period since the opening print, or give or take, apart from this chop here. I think we're going to resume and push lower. And I think my stop's got to be above the high, and you're probably in agreement there. That's a reasonable place for a stop, with the hypothesis of the trade is no longer valid if we're back above there. And if you use the fixed 2-to-1 risk reward ratio, that puts your target right down here. Okay, so you've got to take a break through the low. It's got to continue. You're asking for a reasonable kind of move. It's already done quite a lot. You're asking a reasonable kind of move. Now, if that bar there, the break of the trigger bar, the big wide range momentum ignition to the downside was your signal, and then you said, I am going to wait for the first green to get short, as an example. Now, even that's not perfect, right? It's not the best possible. I'm not saying, oh, you're not getting right at the high here. You're improving the entry by a bit. You're saying the signal bar was my red ignition, and I'm in a downtrend. The context is good. Everything seems good, blah, blah, blah. Everything's lining up. I'm waiting for the pullback like a good boy. Pullback's coming. Get the ignition bar. Right now, rather than just putting the trigger on the close of the bar, I'm waiting for the actual trigger bar, which you can make up for yourself, whatever that may be, and that's looking for the first green. So I want to sell on green. You know, if you're active trader, intraday trader, aggressive trader, you want price to come to you. You don't want to be chasing price all the time. Sometimes, sure, you're going to get trades like this, they run away from you, right? They run away from you. That's part of the deal, right? With trading, what you take with one hand, you have to give with the other. There's no free lunch. But something to consider is if this is something that's happening to you regularly, you can go, right, stop in the same place. But now my signal is the momentum ignition. My trigger is to take the trade on the first green bar close, for example. Could be anything. You come up with yours. That's improved it massively. And now if I'm using a fixed 2-to-1 RVR, the target becomes so much more reasonable, right? It becomes so much more reasonable. I actually don't even have to wait for a break of the low. So I can either say, okay, you know what? I'm going to have a 2-to-1 RVR. And if it double bottoms on me, I don't care. I've still got my profit. Or you stretch it to 3-to-1 and you say, okay, well, actually, I'm going to 3-to-1 will be just on the breakout. I'll be buying back into those sellers of the break. That'll work structurally quite nicely. And that's just a slight adjustment that you made on that entry. And rather than taking it on the close of the low, you said, hey, I'm going to wait for the first green. And listen, you are saying, I can hear your voice going, yeah, but I'm going to miss them. Sometimes they just go off and they go off. Fine. If you're in the right trade at the right time, I agree. Sometimes you've got to see the momentum and you've got to dive on. That's normally the catalyst driven market. That's normally in really, really extreme conditions. But, and more on this in a moment, look at the history of the market before. I say the history, the couple of hours of price action before you got your trade. How many subs bars have you had that have been 3, 4 reds in a row? None. Oh, there's 1, 3, 1, 3 here, but it's choppy. You're seeing mixed bars. You're seeing red, green, red, green. The market is telling you it's still rotational. It's still two-way trade, even though the direction is down. Right? That's very different to if this had been like brutal red, like we had earlier when the news came out, just slamming, slamming, slamming bids. You know, maybe then you want to be aggressive because you think the pause is so shallow. But when you see it chopping around, rotating in kind of a thick range on the way down, you've got no reason to expect to suddenly change sentiment, right? To suddenly change structure. And so waiting for that additional kind of retrace is such a help. Okay, so where are we? Okay. What are you really asking from your trade? So the other thing to think about when you're trading and you're trying to time an entry, the trade might be structurally sound, right? Like this example here, Apple, 5-minute breakout, it looks solid, right? Textbook will say that's really good. You've dipped below the low. You've come and you've broken above the high. Off we go. You know, it's a classic breakout trade. You're going to buy it and you're going to make loads of money, right? You kind of looked at the textbook, you read this and done that, and that looks pretty legitimate to me. But if we look closer, look at the context. By the way, this is it here now. That's the area that we just looked at. Look at the context. We're still in a 3-day range. It's moved what I call its usual move already based on the past 4 days of trade, which is around $2 to $3 rotations. We've got $3 rotation, $2.8 rotation, $2.5 rotation, $2 rotation. From low to high, it's already moved kind of $2 and a bit dollars. You're asking a hell of a lot. So you're asking for it to break out of the range. You're asking for it to change the structure that it has been trading the last 4 days, to break its usual rhythm just because you want to force a breakout trade. And so this is maybe a little bit off piece to touch, but it's just so important for, okay, the hypothesis might be, well, I think Apple's going to go to highs. Well, that might be the case, but just looking at what the market's telling you, just like we did the DAX example, what's the market telling you? How's the change? Now, at some point, of course, it will break. It will start to do something different. The rhythm will change. Maybe it'll force into momentum, it'll downside momentum, a little bit of downside action today in Apple. That's fine, but you wait for it to reveal its hand before you commit. If you're there constantly trying to buy breakouts when you know that historically over the last week or so, it's just been rotational, it's been chopping around, it's been to 224, it's been to 229, it's had these $2 to $3 rotations. You can't then just force what you call a textbook trade onto it because your entry is going to suck. Because where's you going to put your stop? Where's your target? It's just not going to be effective. So, something to think about is if we go upstream one leg, yeah, we're talking about the finer details of the entry and the trigger just a moment ago. But I wanted to go back one layer and go, just look at what the market's telling you. Just look at the current situation, the rhythm, and say, am I asking too much from this trade? Is my target in a really ridiculous place that would have to be the biggest range we've had for the past 20 days? Or, am I asking for something really very, very meaningful to occur, not just direction, but meaningful in terms of price structure? Because if you are, then maybe you need to rethink the trade because it's such a big ask. You're asking quite a lot. So look at the market's message, the rhythm, the flow of the market, what's happened before. I think this is honestly, I think this is so underrated to go back and say, what was normal? Eyeball the chart, get 5 days up and go, what's normal? If we are in massive, relentless bull market, bang, new highs, fresh highs, breaking through, shallow pullbacks, aggression, then by all means, fill your boots, go for the breakout. I'll be there trading the breakouts with you. That looks lovely. But if you're there just looking at that little thing going, I want to trade the break because it's done this, and you zoom out, you're like, well, we're in a 5 day range. We've not really done more than $3 rotations at a time. We've done two and a bit from here. Have we got any catalysts? Is there any reason for it to do anything more than what it's going to at some point? But why would I guess it now? And so sometimes I think looking at what the market's telling you really can help you improve your entries and can help you reduce those really poor trades where structurally you might be like, what, it looks all right. But actually, you're asking so much that you think, what, I'm asking for a lot. I'm asking for a big shift in rhythm. I'm asking for the direction to be right. I'm asking for the noise to suddenly not come back. I'm asking so much from this trade. The chances of success are very, very low. And that's not the business we're in. We're in the business of identifying opportunities where the chance of success is reasonably high, the risk reward ratio is reasonably high, or a trade off of the two. Fine. And then trading. So, example, I just pulled this one up, daily chart of USD CAD. If you're there trying to force a breakout when at here, for example, you're like, oh, it's a breakout. I'm sure it's going to break out at some point, but why try to force that when you're going to have a stop right down here? You're going to have to. The market is just not going. It's just not in the rhythm of the breakout trade. So just look and see the market you're trading and just let it speak to you. It sounds a bit, quackery. Let the market speak to you and trade off that. You know what I mean, right? We're all aware enough to be able to say, okay, that's the price action. I can't change that. And am I forcing something onto the market that's not there? Am I trying to get a square peg into a round hole? Is that right around? You get the idea. Okay, so entry timing. We've got some more stuff to cover. So entry timing, let's go over what we've talked about here. Buy on red, sell on green. I think that's a good way of doing stuff. If you're in the right conditions, that example, we had red, green, red, green, red, green, red, green, red, green. And you could say, okay, well, if I get a red ignition, I'll wait for a green trigger. That's my signal. There's my trigger. And I think in the right conditions, just fighting for the extra few ticks, just fighting for a better entry can have a massive impact on the trade P&L, so it's worth doing. Preempt the move. Back on that yen example. And by the way, I'm cherry picking stuff to show you the best case scenario in the real world. I know you aren't always going to be able to get on this. You aren't always going to be able to get this perfect scenario. But if you can preempt the move, let's say on that yen example, you said, hey, you know what? I think it's toppy. It's running out of puff here. A lot of sellers sitting on the highs, running out of steam, time of day, other stuff going on. I think a rotation back to there is ready. So you're now ready when it does one more bid. You're there going, I'm going to sell that. I'm going to use a reasonable stop on it, and I'm going to sell it. I'm going to see where it goes. And maybe you take a little piece of the pie. Maybe you take a small clip and add another clip, and maybe you kind of portray it like that. But being ready for it, and then looking for the stuff that needs to that kind of reinforce that trade idea can help, rather than saying, oh, that's going to go lower and you're late to the party and you end up getting an awful entry. Consider being aggressive with your entry. And by aggressive, I mean, fighting for the best price. That sometimes means waiting, by the way. It sometimes means patience. and saying, okay, I've had that ignition bar. I need to wait and improve my entry. I want better entry. I'm not going to be chasing this. I need a little pullback. If you're late to a move, think of the next sequence, right? So if you see a market and you see it starting to go, you're like, no, I wasn't prepared for that. Okay, what's the next sequence? That's going to improve your entry rather than chasing it with FOMO. And also, something tactically is you don't need to go down the time frame. You just need to fight for price. And what I mean by this is many people go, well, I'll go down to a 1 minute or I'll go down to 30 second and try and time it. You don't have to do that. You just have to go, right, I need to see a retracement, a 50% retracement of that bar. I need to see some green. I need to sell into green on that little short term. And that can just be watching the price print. You have to look for a pattern as such. It's just right, it's structurally sound on a 15 or 5. Okay, now I just need a little bit of improvement. I just want a little bit better. And sometimes just adding a bid, a limit order, a few pips under the current bid or a few pips above the current offer, it's just fighting for an extra few ticks. And you might be like, it doesn't matter. But over time, you can see it does. You can see that a few pips difference, structurally changes the trade so much. And sometimes you need to pay up for price, but don't always paying up. Example from crude oil today. I didn't trade this, by the way, but I'm just showing you. We had that kind of news come out, rumors that Iran had launched a missile at Israel. Obviously, spiked crude oil. Talked about at the beginning of the webinar. Okay, if you miss this, you're like, okay, oh, do I want to buy it here? I want to buy that? Maybe you go, what's next? Okay, what's next? And this is how you fight for a better price. You go, I want to get long. I believe this is going to keep on pushing. Maybe that's your hypothesis. Fine, that's absolutely fine if you think that. Okay, we don't want to get long. We don't want to get long. Oh, the temptation is to kind of start bidding up here. Now that might be okay if that's part of your strategy. I'm going to buy on this flag, but maybe you go, I feel like it's a little bit high because it could roll down and still be a good rally. And if I end up getting in the 69.75s or 69.50s, all of a sudden I've got $1 in the bank just back to previous highs. And if our hypothesis is correct and we break out, we could easily hit 71, 71.30. And so you start to structure the trade a little bit better and maybe use a moving average. It's not my thing, apart from the 20-year May 1st pullback after ignition. But it's not really my thing, this, but it might be yours. You might say, okay, well, actually, I'd rather wait for it to find a little bit of support at a moving average, three layers of support on a 5-minute chart. Okay, we find some support. That's better. I can work off that. And then maybe you're aggressive enough to then hit that there. Your stop is reasonably tight. All of a sudden, the structure of the trade is beautiful. It's way better than buying here and going, well, I kind of have a stop here, I have a stop here, 50-cent stop, and I'm really looking for $1. It's just a mess. So just fighting for, the best possible price you can. Okay, so talk about entries. Can you fight to improve your exit even on losers? This is controversial, and people aren't going to say this, and that's fine. And some people aren't going to agree with this, and that's fine. I think there's more ways to manage risk than just using a standard stop loss. Now, listen, if you are in the developing phase of how much time we've got some time. Okay, good. If you're on developing phase as a trader, bear with me, guys. Apologies. If you are developing and you are trying to get your discipline on point, you're trying to kind of nail down your ideas and approach, then fine. Just have a fixed stop. I think that's a good way to really get going. Okay, because you can always adjust the stop later. Use a fixed stop, standard stuff. You put your stop in, you get pinged, you're out, you're done. You know where you are. I've always said give and take. If you don't use a fixed stop, then you do open yourself up to more loss than you like potentially. However, there's a trade-off. Let me explain. So if you're always taking a stop and you're always just hitting them, it's always hitting the market, right? If you've got a stop at 59, a sell stop at 59, market's trending up at 60, 61, 62, comes back down, trades at 59, you're out. You get a bit of slippage, you get out at 58, 52, whatever it might be, and you go, okay, I'm done. Because a stop order just basically activates a sell market order when that level's hit. You know that? Right, okay, so do you always need to use that? Now, sometimes you do, and I'm completely agree on that. Sometimes you want to get out as a key level. I want to be done. I don't want to be in the trade anymore. And that's fine. But sometimes you can fight for exit improvements as well. Sometimes you can say, hey, the way I get into a trade can apply in reverse. How many traders do you know fight to get out at a better price when there's a losing trade? Not many. And how many traders do you know are struggling? Many. I'm not saying this. I'm not saying, "Whoa, this is the magic pill." And I found this. No. I'm just saying that I know that if on some trades I'm in a losing trade, but I try to improve my exit, that is going to pay off for me over time. Sure, sometimes you need to just pull the plaster off, take the hit. It's going against me. This is bad news. I don't like it. It's past my point. I don't want to be anymore. Boom, market order, get it done, cut that risk, swallow the loss, move on, take your medicine. But sometimes in the right conditions, you can say, I don't want to be in this trade anymore. It's at the level that I think the hypothesis is no longer valid. However, I'm going to fight for price a little bit. And okay, there is the trade-off that could keep going. You could lose more and more and more. But again, it's you as a trader. It's up to your judgment sometimes to say, well, you know what? I don't need to just bid out or just bail out of this and vomit out the position. You know, it's a rhythm here. Okay, maybe there's a red line where you go, actually, if it goes there, we'll have to. I just don't want to take that much hit. But maybe in the zone, you go, well, actually, now I'm going to come out in the first red. I'm going to buy. Let's say you're short, market's rallying. Rather than just coming out into that high, you can go, I don't want to be in it anymore. Let me monitor it. That's my kind of bailout point above that. But actually, the first kind of rotation down, I'm going to close it. I'm going to fight for price there as well. I'm going to fight for entry price. I'm going to fight for exit price. And again, I want to reiterate that that's not for everybody, and there is a consequence to that. If you're dithering, if you kind of deer in headlights, sometimes don't even address this. But I also want to, wouldn't be fair if I didn't kind of share with you what I think of valuable things to look at on both sides of the coin. So very quickly on this one, optimizing your stop. You've got choices. No stop. I never recommend that. I think whatever you're doing, you should have a stop, even if it's an emergency stop. All sorts of things can happen. Feeds can go down, news can break out. That's a bad idea, but it's an option. And I know some people who do trade like that. They use no stop. And they say, okay, fine, I'm going to trade like that. Don't recommend it. Fixed mechanical stops, what most people use. Hits this level, bang, market order goes in, gets me out. Mental stop, same thing, but it's not in with your broker. A trailing stop, same type of thing. We know that most of the time you're kind of ratcheting it up, whether it's kind of on a moving average or a stair stepping effect. Like Peter does, Traders Mastermind is a real aficionado, if you like, of the stair step effect, and a time-based stop or a hybrid, right? So you can think of how can I fight for price. So if price is rotating a little bit, you say, okay, well, I've got a hard stop here and I've got a mental stop, and maybe I use a trading stop. So you can use a hybrid, kind of a mixture of the bunch. You don't have to always use a fixed mechanical stop. And again, I will like over like a broken record here, but if you're struggling to get traction, if it's an issue, then by all means use a mechanical stop. But if you feel like you've got some traction, you feel like you can fight for price a little bit, you feel like you've got the discipline to be able to come out if a trade is not working, you can improve your exit a little bit, then I think you can optimize your stop a little bit as well there. Okay, so let's wrap this up with a few extra slides here. So a checklist for you. This might be valuable for you. When you're coming into the trade, is the structure of the trade sound? In other words, is my stop in a good position? Is my target in a good position? Is my entry in a good position? That's the key for this one. Do I need to improve that a bit to improve the structure of the trade? And what I mean by that is those examples a little bit late on the deal, and the RVR becomes 1.7. That's a crap trade, man. That's useless. But if I can just improve, the hypothesis is still there, the idea is still there, the thesis is still there. But if I can just get a bit of an improvement on my entry, I can just wait for it to retrace a bit and makes it a 3-1. Bingo. That's a perfect way because the stop's in the same place. The target's in the same place. Nothing's changed. I'm not suddenly going, well, I'm going to tighten my stop right up because I don't want to risk. No, you've said, well, that's what a stop's going to be anyway, regardless if you're in, right? But if you can then improve it a little bit and say, well, I still think it's pulled back a little bit, that's fine. Then the structure changes so much better. Or the structure is so much better, should I say. Is the risk reward ratio reasonable? Am I stopping in the correct place? This is all bread and butter stuff anyway, or basic stuff. Is my target reasonable? So if you're forcing a fixed RVR onto the trade, just like we saw in the yen example, was it USD yen, dollar yen? I think it was. If you're saying, oh, I really want a 2-1, but your stop's so wide because your entry's pretty poor and you're expecting it to break out of a multi-day move and do the biggest range it's done for the past 15 days. You're like, man, is that reasonable? Should I really be expecting that? I'm asking a bit much. And also the key thing here is, I think this is super valuable, is to go back and look at how the market's behaved recently. Like how it's there in front of you. Sometimes when I remember, there's something that's really clicked for me, was just look at the market and it tells you how it's behaved We didn't have to force anything on it. And you go through all the textbooks and say, oh, well, I should do this and do that. The market's telling you everything you need to know. Of course, it shifts behavior. Of course, it does. But you're responding to what's happening and adding your hypothesis. So the conditions are X, right? This is my hypothesis. I think we're going to go to here. So if that happened, where would my stop need to be to negate that? It would be here. Okay, so where's my entry? Okay, here. And it's just that simple process. I think we overcomplicate it by saying, well, it's a really good breakout, but the market's not it's been rotating for the past multiple days, and you're trying to force a breakout at highs. It's already done the average expected range for the day. You kind of got to accept the fact you're going to probably get nailed on that one. All right, so an entry review. We discussed these, but let's go over a few more. Fighting for better entries, time delays. I've got a timer here. I know many of you guys have got a timer as well, and that can be, hey, if you find yourself seeing that signal and you find yourself getting into the trade straight away, the market order, why not put a little bit of a delay in? 1 minute, 30 seconds, 10 seconds, 15 minutes, whatever time frame you're trading. Sometimes if the market's rotational, you're going to get a better price. And sometimes just waiting, come to me, price. You can come to me. I'm not paying up for this. I want this. And you just improve that trade massively just by waiting for a slightly better entry, by fighting that better entry. Okay, sometimes you're going to miss one. But I think on balance, that ends up paying off. Waiting for a different trigger. So that the idea of the filter, signal trigger process. So hey, I see the ignition. I'm not going to buy on that. I'm going to wait for now, a retracement. I'm going to buy on the first red or whatever it might be. I'm going to buy the first pullback. I'm going to wait for a 50% retracement. I'm going to buy. We saw the examples there. Limit orders, even a few ticks under the bid can help. Even just saying, for every trade I do, and you can easily do this, by the way. You can go back and look at your charts and say, hey, if I just put a bid on all my longs, 5, 6, 10 pips under the market, would I have been filled? Well, I've been filled 8 times out of 10. How would that have improved this? Well, massively, because I would have been able to increase my position size. Don't forget, because if your target's fixed and your stop is fixed, even if your target's not, your stop is fixed because the hypothesis of the trade is invalid. You can increase your position size because the absolute risk is still the same. We talk about the example of £100 risk, which is an arbitrary number. If your stop is now, actually, I've improved my entry by 50%, you can use double the position size because the stop is still the same place. All of a sudden, it makes a massive impact. So it's not just, oh, it's only a few ticks. Who cares about a few ticks? It doesn't matter. It matters because it changes the structure of the trade. And hopefully that makes sense. Okay, so exit review. Can you fight for better stops? Do you need to hit it all out at once, or can you work the order? Maybe you split your order and work half. If it's new to you, like, oh God, I feel uncomfortable doing that. Maybe put a stop for 75%, 80%, 90% of your order so it comes out automatically. And then you work 10%. You go, okay, can I improve that? Maybe you can't. Maybe it's fine using a market order, come out at key level. That's absolutely fine. I've got no problem with that. But maybe you can fight for a better price. If you find yourself getting pinged on wicks and tails a lot, then maybe you can widen the stop as an emergency and then look and say, hey, got an alert here at the stop where I would be. I want to get out, not holding it, hoping. We're not saying I'm going to stay in it. You still want to exit, but rather than coming out right at that extreme, you go, you know what, I'm going to wait for a little bit of retracement, then I'm going to come out. So I'm still going to take my loss, still going to be losing trade. I'm not holding, hoping it's going to come back round for me, but I'm going to try to improve my exit just a little bit. And not for everything. I appreciate that, but something you can consider. Okay, so summary, guys, before we go to some Q&A, if you do have any. I'll definitely try to help if I can. Assess the context, analyze the most likely target. So context of the market, I think is so key. What's the rhythm? What's the structure? Where's your most likely target? Where's the best place to express that idea? That's the thing. That is the thing. You've got the idea, and we all probably have pretty good ideas. How many times you write in direction, you write in thesis, but you just get pinged because the place to express the idea isn't now. I've got to do it now. I've got to take it now. I've got to take it now. It's I want to see a place where I can really maximize this. I want to use price action to my advantage. I want to use the ebb and flow of bid and offer to my advantage, the supply demand shift to my advantage. Okay, I want it. I want to get on it. I think we're going to bid. I think we're going to hit the highs. But I'm not paying right up here because we could rotate back and it means my stop's got to be here. The structure of the trade is just nonsense. Just thinking like that, thinking a little bit more, leveling up your way of thinking. And where my stop need to be and how will it be triggered? And again, it's fine if it's just a standard stop, bang, ping, you're out, you're done. But if you're at the screen and you can manage that and you think that that may be something you can consider, then fine. If you're your position size should be in a sensible position anyway, right? You shouldn't be going a crazy size so that each trade is so meaningful that a bit of slippage kind of ruins the structure of the trade. It should be like, okay, small size, trading with small size. I've got my risk managed, just different ways of considering to manage risk. I wanted to mention that many of you know this already, but I do have a discipline tracker for Google Sheets. It's like a thing I had coded up for me, helps to track discipline and improvement. So you fill out the column and you kind of tick every time you do something throughout the month. And rather than trying to improve instantly, you might say, "Hey, I want to hold trades a little bit longer," or "I want to fight for price." Great example. I want to fight for price. And so every day you go, "Did it? Oh, I didn't do it today. Did it?" And you see your progress visually in a kind of chart format. And then the next month, where you get the same sheet on the next tab on the Google Sheet, you go, okay, well, I want to improve that. I did it 75% of the time. I want to do it now 80. And you can do this for as many as you want. And there's different kind of features in that as well. So if you like that, you can download that. You go to tradersmastermind.com. And if you click on discipline track on the top right menu, you will see this. You can enter your email address and it will be delivered to your inbox. There have been thousands of people who have downloaded this and really been valuable to them. So I'm offering you no charge. You can absolutely use that and feel free to utilize that as an assistant to your trading. Okay, so let me take some questions, ladies and gents. Thank you so much for today. Phew, I think I've talked non-stop. If you're still listening, you're still paying attention. Of course, been a thick one today. We've really covered a lot of ground. Okay, let's roll. I'm going to bring you over here for the questions, ladies and gents. Okay, so Tony says, how do you stop the deer in headlights effect and seeing your trade go opposite for longer than necessary? Do you know what, Tony? This comes down to knowing exactly the position that you. If okay, let me rewind a bit. If this is your challenge, so you're in a trade, it's going against you, then using a fixed stop is probably the answer for you. And it's just sticking to that stop and saying, okay, and how you come up with the stop is saying, right, where do I not want this trade? Where, if the price goes there, what would invalidate this completely? Okay. And then you go, right, put my stop in it, and then you don't touch it. But actively managing a trade is, it's really for when you very rarely does it serve you. There's been talk of this on social media and stuff quite a lot about actively managing trades. So if your argument, if I need to be at the screen because I need to manage the trade a little bit more effectively, then it probably isn't going to stand up to scrutiny into a kind of research and analysis of your trades. So the easy thing for you to do is just to say, right, my stop's here, okay, and that's it. I'm just going to come out on that, and you just get used to sticking to that stop. Now, if you're talking about, okay, how do I manage the trade and blah blah, the best if you don't want to use a fixed stop, have a fixed stop as an emergency stop. Draw a zone as if if you use TradingView or any trading platform, draw a rectangle of where you want to exit the trade, and then say, right, in that zone, if the price in that zone, I need to come out of it. If it goes out of the zone, I'm done. The stop's going to pull me out of the trade anyway. But get used to kind of just coming out of the trade and cutting the loser, cutting the loser, cutting the loser. Right now, one other thing you can do, Tony, if it's a discipline thing for you and you find yourself kind of holding a trade, hoping it comes back, is to do what I call the coin toss drill. Now, stick with me, stick with me. The coin toss drill is this very, very small size demo if you want. Probably risk guys would say, I have to say you have to use a demo, but obviously you're not going to risk proper capital with this. You toss a coin. Heads you go long, tails you go short. A specific time of day that you can be at the screen. And you set parameters like I'm going to use a 10-point stop and a 10-point target. And this is a drill to get you used to executing and doing what you know you should do. So you toss a coin, it's heads, you go long, goes against you 10 points, you just close it. You just get used to taking that loss, taking that profit, pulling the trigger. You just get used to executing and doing what you said or sticking to your plan. And yes, okay, coin toss is not going to be effective in terms of strategy, but what it does is it seasons you into actually, reacting in the correct manner. Hey, I've hit my stop. I'm out. I'm not second guessing it. I'm not hoping it's going to come back. And the more you do that, the more you create the neural network, should I say, the muscle memory. And so then in the real world, and you're trading normally, so to speak, you're going to go, okay, hey, well, actually, I do need to just come out of the trade. I do need to just come out and just take the stop. And that just starts to then hopefully build your ability to do that without thinking. But Tony, that's not serving you. How often have you done that? And it's come back now and then, and you've gone, oh, it might come back, but then it only takes one way you're stuck in the trade, you're in the deer in headlights, it's going against you, it goes against you, goes against you, goes against you, and you end up wiping out. And that's frustrating because there's one chink in your armor that maybe negatively impacts what could be a decent strategy. Okay. Thank you, Tony. That's it. Right, you guys have had enough. Okay, fair enough, guys. It is 7 o'clock. Crude has rocked back a little bit, testing that 70 print. Let's see, back again next week with another one. Appreciate all of you for coming here and listening to me live. I know you've got stuff going on. I know the market is busy, but I do appreciate that, knowing that you're here listening and there is someone on the other end of this makes it a bit more energetic, hopefully, for you. Hope it's been some value. Take care, guys. See you next one. Bye-bye.